Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at LightPath Technologies.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, imagine knowing exactly what the U.S. military is going to buy for, like, the next 4 years.
Right, because Congress literally banned them from buying it from anyone else.
Exactly. I mean, that is the exact scenario playing out right now with a pretty misunderstood microcap company called LightPath Technologies.
Yeah, we are definitely looking at a classic Wall Street blind spot here.
Oh, 100%. The market just, it takes time to realize when a company fundamentally alters its DNA. This isn't just some sleepy little component supplier anymore. They are actively transforming into a fully vertically integrated defense prime.
And that transformation, it's creating a really highly visible wealth-building opportunity for you. I mean, when a company is suddenly handed this massive, sweeping government mandate, it basically fundamentally changes the floor of their valuation.
Right. It puts a net under them.
Exactly. So we're looking at a staggering revenue surge, but to be clear right up front, transitioning from a small-scale supplier to a major defense contractor, it introduces some severe execution risks.
Naturally, yeah.
So our mission today is to really map out both the explosive upside and, the potholes that could completely derail the entire thesis.
Right, because this isn't a story about a company just, like, tweaking its marketing and selling a few more widgets. This is about structural, geopolitical, tectonic plates shifting, right? And forcing billions of dollars into very specific domestic channels.
Yeah, the landscape has completely changed.
So let's look at the actual scale of this shift. If you want to know why this company suddenly demands your attention right now, just look at their fiscal second quarter of 2026.
Which wrapped up in December 2025.
Right. Revenue hit $16.4 million for the quarter.
Which is just a massive acceleration. I mean, put that in perspective for a second. That is a 120% year-over-year increase from the 7.4 million they reported in the exact same period the prior year.
120% growth.
Yeah.
For a manufacturing company.
Yeah.
I mean, that is software-level hyper-growth. That doesn't happen with physical goods very often.
No, it really doesn't. But, top-line revenue is only half the wealth-building equation here. What actually matters is the operational leverage they're demonstrating.
Okay, break that down.
Well, while revenue went up 120%, their gross profit surged by 212%.
Wow.
Yeah, hitting $6 million.
Let's pause there for a second because operational leverage is one of those terms thrown around on financial TV all the time.
Right.
In plain English, that just means they aren't just selling more stuff.
Right.
They've actually figured out how to make each piece of tech significantly cheaper as they scale up.
Exactly. Think of it like a factory. Your rent, your heavy machinery, the baseline administrative costs, those are fixed.
You pay them no matter what.
Right. So if you're only making 10 lenses a day, each of those 10 lenses has to carry a heavy burden of those fixed costs. But once you scale up to making like 10,000 lenses a day, the fixed cost per lens drops to almost nothing.
So every additional unit sold just drops almost entirely to the bottom line.
Exactly. Growing your gross profit almost twice as fast as your revenue, that is what transforms a decent manufacturing business into a cash printing machine.
Okay, I love the sound of a cash printing machine, but I have to hit the brakes here and play the skeptic.
Fair enough.
Because there is a massive elephant in the room on this earnings report.
The net loss.
Yeah. You read through these incredible top-line numbers, the operational leverage, the gross profit, and then you scroll down to the bottom line, and the GAAP net loss actually widened to a negative $9.4 million crater.
Yeah, it looks bad on paper.
I mean, if I'm an investor looking at a microcap and I see a $9.4 million net loss in a single quarter, I'm hitting the panic button. So tell me why I shouldn't be panicking right now.
So if you just scan the headline, GAAP numbers, generally accepted accounting principles, it absolutely looks terrifying. But we have to peel back the layers of how corporate accounting actually works to see what is draining cash versus what is just a paper adjustment.
Like technicality.
Exactly. That $9.4 million loss was heavily distorted by a single $7.6 million non-cash change in the fair value of acquisition liabilities.
Related to the G5 acquisition.
Yes, related to G5.
Okay, that is a very dense financial sentence. Let's really break the mechanics of that down for the listener. How does an acquisition liability cause a $7 million paper loss?
Okay, let's say you buy a smaller company. Often you don't just hand them a flat check and walk away. You structure the deal with earnouts. You tell the founders of that smaller company, hey, we will pay you an extra $5 million next year, but only if you hit certain aggressive revenue targets.
So it's performance-based.
Exactly. And on your balance sheet, you have to estimate the likelihood of paying that out. It's a liability.
Right, because you legally owe them that money conditionally.
Exactly. Now, what happens if that acquired company absolutely crushes its targets? Like they perform way better than you initially modeled.
Well, then you have to pay them the bonus.
Right. And in the accounting world, you now have to adjust the value of that liability upward on your balance sheet. Because you suddenly owe more money than you originally planned, you have to record that adjustment as an expense or a loss on your income statement for that quarter.
Even if the cash hasn't moved yet.
Even though no actual cash has left your bank account yet, you just take this massive accounting hit.
So wait, ironically, taking that massive $7.6 million paper loss is actually a signal that the company they acquired, G5, is performing exceptionally well.
That is precisely how you have to read it. The business is thriving, which is triggering the earnout liabilities.
Oh, wow. That changes the perspective entirely.
Yeah, if we strip out that completely non-cash paper loss and just look at the actual day-to-day operational health of the business, the picture flips. On an operational level, their adjusted EBITDA actually turned positive to the tune of $600,000.
Meaning the core business of making and selling optical tech is now generating positive cash flow.
Yes.
And compared to what? What were they bleeding the year before?
They had a loss of $1.3 million in the prior year.
Okay, so swinging from a heavy operational loss to positive operational cash generation, I mean, that's the exact inflection point wealth builders look for.
It really is. And we aren't just guessing that this momentum will continue either. They are sitting on a record backlog of nearly $100 million.
$100 million?
Yeah. That is legally binding future revenue sitting there just waiting to be manufactured and converted into cash.
But, I mean, a backlog that size doesn't just fall out of the sky for a microcap company.
No, it doesn't.
Which brings us to the ultimate regulatory moat. Let's talk about why the defense industry is suddenly, cooking down LightPath's door.
This is the absolute cornerstone of the bullish thesis. We have to look at Section 834 of the Fiscal Year 2026 National Defense Authorization Act, the NDAA.
Okay.
This legislation is a structural tailwind of just epic proportions. It legally mandates that the Department of Defense must completely eliminate its reliance on optical glass from covered nations by the year 2030.
By 2030. So the clock is ticking aggressively. And covered nations, that primarily means China and Russia.
Primarily, yes.
And just to give everyone context here, prior to this, defense contractors were heavily reliant on foreign supply chains just because it was, cheaper to import optical components from overseas.
Exactly. For decades, the global supply chain prioritized cost over security. But geopolitics have shifted dramatically. The U.S. government basically realized it is a massive national security vulnerability to rely on foreign adversaries for the critical components that go into things like missile guidance systems and night vision goggles.
That makes total sense.
So the government is sort of playing the role of a VIP bouncer at a club. They are systematically kicking out all the foreign competitors, and LightPath holds the exclusive VIP pass to stay inside.
But wait, if there's this massive vacuum of demand, why can't massive domestic competitors, like Lockheed or Raytheon or even just other well-funded domestic glass manufacturers, just decide to make their own optical glass and grab a slice of this pie?
Because defense-compliant supply chains cannot be built overnight. And frankly, you can't just throw money at the laws of physics.
What do you mean?
We are talking about highly specialized microscopic precision. Normal glass absorbs infrared light. If you are building a heat-seeking missile, putting regular glass over the sensor is literally like putting a blindfold on it.
Right. Wouldn't see anything.
Exactly. You need a very specific material that transmits infrared light perfectly.
And that is where their specific technology comes into play, right? The black diamond chalcogenide glass technology.
Exactly. Chalcogenide glass is uniquely formulated to let infrared light pass through seamlessly while also surviving extreme military environments. It's basically the essential lens for modern thermal warfare.
Wow.
And LightPath doesn't just know how to make it. They have exclusive rights to the black diamond technology, which they license directly from the United States Naval Research Laboratory.
So they literally hold the U.S. Navy's own proprietary recipe for this glass. Exclusively.
Yes.
Well, that explains the moat. I mean, a competitor can't just spin up a factory and replicate this.
Yeah.
Because LightPath legally owns the specific technology the military helped develop in the first place.
Exactly. It creates a staggeringly high barrier to entry. If you are a massive defense contractor and you need the specific, compliant, advanced optical glass to fulfill a billion-dollar weapons contract, LightPath is essentially the only game in town.
Right. The government slammed the door on foreign suppliers, and LightPath holds the domestic key.
Okay, the narrative is incredibly compelling. They have the VIC pass, they have the Navy's recipe, and they have a $100 million backlog. But let's follow the money here. Because building $100 million worth of advanced military tech requires massive upfront capital for factories, raw materials, specialized labor, and that's all before the government actually pays the final invoice. How are they keeping the lights on while they scale up so fast?
Well, they recognized that to capitalize on this mandate, they just couldn't operate on a shoestring budget anymore. They needed a fortress balance sheet. So in December 2025, they closed a $60 million public offering of common stock.
Wait, $60 million for a company of this size? That is massive dilution.
It is a lot, yes.
If I'm an early shareholder, my slice of the pie just got dramatically smaller. Why shouldn't investors view that as a huge red flag? I mean, usually when a company issues that much new stock, the market completely punishes them. Dilution is always a bitter pill, I totally agree, but you have to look at how the capital is being deployed. If they raise $60 million just to keep the lights on and pay executive salaries, then yes, panic.
Right.
But this capital infusion completely de-risked their balance sheet against any near-term macroeconomic shocks, and more importantly, it funded their acquisition strategy.
Oh, you're talking about the amorphous materials and G5 integrations.
Yes. They used that cash to buy the companies that make the raw materials and assemble the final lenses. This is how you achieve that vertically integrated defense prime status we talked about earlier. They aren't just buying glass from someone else, shaping it and selling it anymore. They are acquiring the pieces to own the entire manufacturing pipeline, from the raw chemical compound all the way to final military-grade assembly.
Which captures exponentially more margin.
Exactly.
So it's accretive dilution. You own a smaller percentage of the company, but the company itself is fundamentally vastly more valuable and, profitable.
That's the way to look at it.
And the analysts clearly agree with that deployment of capital. I mean, the sell-side sentiment is overwhelmingly bullish right now. Craig-Hallum initiated coverage with a buy rating back in April 2025. Then you have H.C. Wainwright, Ladenburg Thelman, and Lake Street Capital all coming out and reiterating buy ratings in November 2025, right after those earnings drop.
Yeah, the Wall Street analyst community is firmly on board. But if you look past the analyst ratings and actually examine the institutional money flow, like who is buying and selling millions of shares behind the scenes, it tells a much more nuanced story about where this stock sits in its life cycle.
Let's dig into that, because I noticed a glaring contradiction in the institutional ownership that I really need you to explain.
Okay, well, what is it?
Well, if the story is this bulletproof, if the NDAA mandate is locked in, and the backlog is sitting at $100 million. Why did Royce and Associates trim their position by over 23% in the third quarter of 2025? If the smart money is selling, what do they know that we don't?
It's a really critical detail, and it routinely spooks retail investors because they fundamentally misunderstand how different funds operate. What we are seeing here is basically a textbook risk profile shift. Think of it like flipping a house.
Okay, walk me through that.
So Royce and Associates are historically deep value investors. They are the contractors who bought this house years ago when it was just a rundown, ignored microcap foreclosure.
Right, high risk.
Exactly. They took on a massive risk betting on a turnaround. But now the foundation is fixed, the revenue is exploding, and the valuation has multiplied. For a deep value fund, their mandate actually requires them to take some chips off the table.
So they're just selling the renovated house.
Right. But notice, even after trimming 23%, Royce still holds a 2.85% stake, which is valued at over $10 million. They aren't abandoning ship, they are just locking in the profit from the renovation phase.
Okay, so if Royce is the contractor selling the flipped house, who is the wealthy family moving into the finished product? Like, who is actually buying all the shares they are selling?
The growth-focused, massive institutional players, Vanguard Group actually increased their stake by nearly 4%.
Oh, wow.
Yeah. And even more telling, brand new institutional entrants jumped in during that same third quarter. Heavyweights like Principal Financial Group and Calamos Advisors established entirely new
And
positions.
Vanguard and Principal Financial, they aren't looking for a scrappy turnaround story. They are paying a premium for a finished, scaling product.
Precisely. They are buying into the hyper-growth defense prime narrative. It confirms that the shareholder base is successfully resetting at higher price points, replacing those early value hunters with long-term growth capital.
Which brings us to a really fascinating piece of corporate maneuvering. They recently appointed Mark Kaler to their board of directors. He is a major, seasoned defense industry executive.
Very seasoned, yeah.
And you don't just put a guy like that on your board for his charming personality. What is the actual tactical strategy there?
Bringing a high-level defense executive onto the board is all about acquiring a very specific Rolodex. The defense sector operates on deep relationships, complex procurement processes, and knowing exactly how the Pentagon writes its contracts.
It's an insider's game.
Exactly. At the very least, Kaler's expertise signals a deliberate pivot toward securing massive, prime-level defense contracts rather than just being a subcontractor. But at a macro level, someone with his background is critical for integrating those M&A targets like G5, or, crucially, preparing LightPath to be an attractive acquisition target itself down the line.
All right, so the bullish setup is incredibly well-defined. We have the government mandate, the exclusive tech, the smart money rotating in, and a fortress balance sheet. But to build real wealth, you can't just stare at the blue sky scenario.
You have to look down.
We have to map out the horizon over the next 3 to 6 months, and we have to relentlessly look for the potholes that could derail this entire thesis. So what is the bear case here? What actually breaks this company?
Let's start with the immediate timeline, the catalyst calendar. Investors need to circle May on their calendars. That is when the third quarter fiscal 2026 earnings will be released. The single most important metric to watch isn't just top-line revenue, it's the conversion rate of that $100 million backlog.
Right, because a backlog is just a promise on a piece of paper until you actually manufacture the lens, ship it, and get the Pentagon to pay the invoice.
Yeah.
If that backlog isn't converting to cash, it's totally useless.
Exactly. We also need to watch the defense conference circuit in the second quarter, specifically the SPI Defense Plus Commercial Sensing event.
Why that one?
This isn't just a regular trade show. This is literally where Department of Defense contractors go shopping. It will be the major platform for LightPath to demo new products utilizing that exclusive Black Diamond technology, effectively trying to add even more to that massive backlog.
Okay, but let me push back on the valuation of the stock itself. Because you read the analysis on financial forums, and the word stretched comes up constantly.
Yeah, it does.
Is this a scenario where we have a phenomenal, world-changing company, but a terrible stock price? Because every ounce of this good news, the mandate, the backlog, the Navy tech, is already fully priced in by the market.
That is the primary risk, and honestly, it is a completely valid critique. When a valuation is stretched, you are walking a tightrope with absolutely zero safety net. The current share price relies on flawless execution over the next 12 to 18 months.
But manufacturing is never flawless. What specifically could trip them up?
Integrating those recent acquisitions. Merging companies is notoriously difficult. If there are any integration missteps with the G5 or amorphous materials deals, like if corporate cultures clash, if the software systems don't sync up, if the raw material pipelines get delayed, it will slow down their ability to clear that backlog.
And with a stretched valuation, the market won't tolerate that.
No, any delay in revenue recognition could trigger a severe and sharp derating of the stock price. The market will not be forgiving.
So they have to execute perfectly, and they have to do it against a macroeconomic backdrop that is, frankly, incredibly volatile right now.
That is the second major headwind. The broader tech sector is experiencing significant weakness, heavily influenced by ongoing tensions and conflict in the Middle East.
Right.
While LightPath is defense-focused and therefore theoretically insulated by stable government budgets, a broad market sell-off acts like gravity. If major institutions are liquidating tech holdings across the board to reduce risk, it could cap LightPath's upside momentum regardless of how strong their individual quarterly numbers are.
And speaking of those stable government budgets, isn't severe customer concentration a massive, glaring risk here? If your only real buyer at the end of the day is the U.S. Department of Defense, you are entirely at the mercy of their notorious bureaucracy.
It is the ultimate double-edged sword. The government mandate is the foundation of their entire moat, but relying so heavily on the defense sector means any political gridlock in Washington, a delayed defense spending bill, a government shutdown, or a specific program cancellation could instantly freeze their ability to realize that $100 million.
Yeah, they're hitched entirely to the Pentagon's wagon.
Completely.
So synthesizing all this, the explosive growth and the very real execution risks, where do we ultimately stand on this wealth-building opportunity?
Looking at the fundamental setup, the company earns an 8 out of 10 bullish score. The core thesis is undeniably strong. We are witnessing a misunderstood microcap transform into a vertically integrated defense prime. You have a 120% revenue surge backed by a massive backlog and a regulatory moat strictly enforced by the 2030 NDAA deadline.
It is a genuinely rare combination.
Yeah.
You do not often find software-level hypergrowth paired with a federally mandated monopoly on critical military technology. But, just to be clear for the listener, this is not a quick day trade scenario.
No, absolutely not. The target horizon here is a multi-year hold. We are looking at a 12 to 24-month window minimum. The NDAA mandates are accelerating, but the true value inflection point, the moment the stock truly reflects, the new reality of the business won't happen until we see that massive backlog fully and consistently convert into operational cash flow.
Right.
Proving they can integrate the new acquisitions without stumbling will take time.
Which brings up a really provocative thought to leave you with. We are marching closer and closer to that 2030 NDAA deadline. The government is actively locking out foreign optics, and LightPath holds the domestic key. We know defense sector consolidation is almost always the end game in these cycles.
The big fish always eat the small fish.
Exactly.
Yeah.
So you have to wonder, as this domestic player builds out an exclusive, highly specialized technological monopoly, at what point do they become an inevitable acquisition target themselves?
It is the logical conclusion to the entire narrative. I mean, if you are a Lockheed or a Raytheon and you are mandated by law to use this specific glass, why keep paying a premium to a supplier? If LightPath holds the only VIP pass to the club, eventually a massive defense prime is just going to try and buy the whole club.